Hey, good morning, everyone. I want to welcome everyone participating in this morning's webinar. My name is Lindsay Dean, and I'm a senior manager at Gelman, Rosenberg Freedman, and I'm going to be today's moderator. I'm going to start off today with some quick housekeeping items and then explain what the participants need to do to earn their CPE credit for today's webinar. For the best sound quality, we recommend that you connect by the phone instead of your computer. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The webinar will also be recorded and is going to be available on our website following the event. The slides will also be posted at the address shown on the slide. For the participants that are seeking CPE credit, you have to complete a short evaluation survey that will appear automatically right following the webinar. Please write down the CPE words when they are given because they will not be provided again. You'll be asked to recall these words in order to receive your credit. If you have an active pop-up blocker, please take a moment and disable it now so it will not block the survey. Any technical questions about the survey can be addressed to Dominic Acosta at dacosta@grfcpa.com. As the title of the webinar implies, today's learning objective is to provide attendees with a better understanding of functional expenses and indirect rates. One CPE credit is available to attendees of today's webinar. With all that said, welcome to today's webinar, Expense Allocations and Indirect Rates, Changes in Trends and Implementation for New ASU 2016-14. Now I'm going to introduce the instructors. Jennifer Arminger is a nonprofit audit partner who has been working in public accounting for her entire career and possesses expertise in auditing and accounting for tax-exempt organizations. She is a frequent speaker on compliance with uniform guidance and leads a seminar and webinar series aimed at bringing financial management education to Maryland, DC, and Virginia nonprofits. Andreas Alexandru is a nonprofit audit partner and has been auditing tax-exempt organizations since 1996. His expertise includes financial audits and internal control consulting engagements for nonprofit organizations, including associations, internal organizations, private foundations, and other charitable institutions. And with that, I'm going to turn the presentation over to Jen.
Great. Thanks so much, Lindsay, and good morning to everyone joining us. We're so happy to be presenting this morning's topic, which is a very sought-after topic in the industry. And while functional allocations and indirect rates have been a topic of conversation for a long time, there are certain recent developments in the industry, especially given the new standards that have been released that will really set the tone for today's webinar and guide the conversation. So we look forward to that. A quick highlight of our agenda, I'll be taking a look at those functional allocations and the functional expense statement, and then I will hand it off to my colleague Andreas to take a look at those indirect rates and give you some examples of real life applications that you could take back to your own organization. So let's go ahead and get started. So the first thing to remember as we start our discussion on the functional expense statement and functional allocations is to keep in mind that there are many approaches to this, and that, of course, every organization will be different. But what we aim to give you today is some guidelines, some common practices, and some best practices that we see most working with our tax-exempt organizations here in the DMV and really across the U.S. So first and foremost, this concept of a functional expense statement, a functional expense allocation, is very unique to tax-exempt organizations, so the nonprofit world. So this isn't found in the for-profit world, and so a lot of us, us being the nonprofits, certainly struggle with having our boards understand these types of statements, because generally board composition is made up of professionals that might live in the for-profit world. So not only the functional expense statement in particular, but just the general overall presentation of nonprofit financial statements because becomes a task for us in board education. So very unique to nonprofits, and what it does is it presents the cost of an organization not only by its natural expense category, but also presents it on a programmatic or a supporting services basis. So we'll take a look at an example in a little while, but it tends to be in a matrix format with natural expenses down the sides being the rows, and our programs and supporting services across the top. And so the allocation plan or process is what occurs when we spread the costs across these programs versus supporting services. And so this statement or this process has always been a best practice within the nonprofit industry. And so some organizations have already set up uh, to include a functional expense statement in their financial statements, but it was not required until the release of the new accounting standard, which we'll go into a little bit. So moving forward, while it has been a best practice, it now becomes a required part of the basic financial statements. And so organizations have generally done this for 990 purposes, although it might be in a more condensed format. It will now be in a more expanded format for financial statement purposes. And so outside of actually being just a required part of the 990 and the financials, it's actually ultimately used as a measure of efficiency for an organization. That's key in understanding that the users, your constituents of these financial documents, your donors, your funders, your charitable givers, and the public are using this type of information to draw conclusions about your organization and its efficiency based on this direct thing, this functional expense allocation. So it becomes extremely important from a funder and public perspective, and really, we take it one step further. This ultimately is how those charitable watchdog organizations are getting their information as well, to reach you. And so understanding what goes into the process and being able to come up with a functional expense allocation plan that appropriately reflects how your organization is utilizing its funds is critical. So I want to take us through a couple of some very simplified basic processes to put together a functional expense statement or develop a functional allocation plan. And so one of the very first steps that I think is critical in this process is to clearly define all the different components that you would need to be able to do this. So without clear definitions, that's when we get a little muddied on, what belongs where and what we're allocating, and more so what gets muddied on how we communicate it to maybe people taking over the process or non-financial people in our organization, so that they understand the importance of tracking costs in this manner. So first, defining a couple of things. I think first and foremost, what are our natural expense categories. So this just being very basic and will probably follow your chart of accounts that you already have set up. So our salaries, our travel, our benefits, our consulting, those are the natural expenses that need to be defined. And sometimes, you could have a natural expense category, travel, that ultimately will have a multitude of subcomponents. So travel meals, travel transportation, travel lodging, things like that. But ultimately will roll up into what you all want to present or consider as just one line item, travel. What I think is more important than the natural expense definitions are the organization's fundamental core programs. And so, not the, so if we're looking at a matrix, the right side, the rows being those natural expenses, across the top, our columns would be our programs and our supporting services. And so, really understanding what the organization's core programmatic activity is critical. And we could get into a much further conversation about this and how that should align with a strategic plan or a forward thinking basis of what the organization is doing. Where we see a lot of nonprofits that might get held up in defining programs is that one, they're outdated. They might not have taken a look at these programs in a very long time, and you're trying to fit maybe some current activities in a program that really it might should be a program of its own, but it hasn't been looked at by key management in several years. The other thing that we typically see is organizations could mistake individual grant activity for more higher arching programs. And so, the way I like to think of it is that the organization could have one fundamental program with maybe 5 grants that could roll up into that program to accomplish that mission. And so that really does align with just the greater mission and a way the organization plans their strategic plan. So it should be looked at least annually. And if the organization is going through changes or restructuring, it should be maybe looked at more often. But defining those set programs will be a significant step in this functional allocation approach. I think the next thing that you would need to look at is then on a more granular level and taking a look at those costs, those natural expenses, and you're defining what is really a direct cost. So a cost that can be 100% attributable to a specific grant, a specific program by one cost objective versus defining indirect costs that are potentially being utilized by multiple cost objectives, multiple programs, the organization in general. And so this step is really where you see the day-to-day application of the process happening. And so in those invoice coding and review of the expenses and review of coding of the expenses, identifying which costs are directly tagged to grants or programs and those that are indirect and have the potential to be allocated. And so when we define something as indirect, then we take it one step further and say, well, there are indirect costs that are truly management in general or fundraising and should remain management in general and fundraising, or we have indirect costs that are ultimately being utilized by multiple programs, and we feel that in order to run those programs efficiently, efficiently, they should share in the portion of that indirect cost pool. So making a distinction between those indirect costs that will then be allocated out to the programs and our other supporting categories. So the presentation, I just want to give you a quick overview of the presentation of these statements because I think it gives a good perspective before we dive into kind of what the basis for allocation might be. And there are two common presentations for a functional expense statement that we see most often that kind of reflect how the process happens on a day-to-day basis or on a periodic basis. And so the first statement, and I'm going to flip to it because I think it's easier to visualize this way. Here you'll see that along the side, we have our natural expense categories, the salaries, the consultants, travel, rent, and across the top, we have two identified programs. So this particular organization has identified that they do two programs in the course of their strategic mission and vision. And then they have a supporting service column that is labeled management and general. And all the costs from here are presented above the line and are directly identified within the categories. And so rent and utilities, for example. I think that's a really easy category to understand when we say office space. Office space isn't generally a direct cost because it typically supports the overall organization and isn't directly identifiable to one grant or one program. But here in this statement, they have allocated it to those different categories, to the subcategories. And so this is called an above the line or direct allocation presentation. Whereas on this statement, what we see, the first thing that really jumps out at me is the below the line presentation, the overhead allocation. And so again, I think rent is a good way to understand where here this organization has taken, or let's say the majority of that rent is in the management and general column. But if we go down below the line, we've identified approximately 1.8 million of that $3.8 million of management in general as indirect costs that can be allocated. And so I would guess rent and maybe even depreciation are part of this indirect cost pool, and it is done in total below the line. The other thing about this statement that's a little different than the previous statement that we see is that the supporting services actually has two categories. So here we have a management in general and a fundraising. And sometimes we can even see a third category, or really there could be a multitude of categories, board governance, or we see development a lot as a supporting service. So, I just like to highlight that difference between the first and the second statement that we see here. Additionally, both of these statements are very simplified on the programmatic side. Again, depending on the complexity of your organization, you might have 3, 4, 5, 6 programs that roll up into a total program service on your statement or on your financials. So again, that's just keeping in mind that every organization is different. There's certainly no right or wrong way, but it should be best reflective and best representative of the work that you all are doing. So we started to talk a little bit about the idea of allocating costs, but we really haven't yet to explore how that process is accomplished, or some of the basis that you could potentially have for allocating costs across those categories. And I will say, the most common approach, the one we see the most often, is salaries. The salaries and the tracking of time as the basis for allocation of costs. It's certainly not always the case, and we'll give you some other examples of other bases that we do see. But typically, personnel costs, people, salaries, benefits are the largest expense to any organization. And so, taking the approach that our largest line item, one, needs to be allocated, and then two, having that as a reasonable basis for allocating other shared costs, that becomes a methodology that we see quite a bit. In tracking of, you say, okay, so how do we use salaries as the basis for our allocation? Well, tracking of time on how employees are spending and using their time is one way. We often recommend here timesheets as the best way to capture this data. And I know we have a lot of organizations on this call that range in size, range in complexity. Some have federal funds, some probably don't at all, maybe associations. Some might be very small and startup organizations. And timesheets just aren't feasible. They add an administrative burden to an organization for tracking time on a day-to-day, and then taking that and allocating those costs. But outside of those that receive federal funding, and Andreas later will talk a little bit about the requirements are much more stringent on those that receive federal and tracking of time costs. There is some flexibility on using, an estimate throughout the year, monthly, quarterly. Some organizations that, don't have donor reporting or heavily restricted donor or federal funding do an annual estimate based on each employee's best guess as to how they spend their time. But, that all goes back, and this is kind of speaking to the actual versus estimates topic that we have here. But really the more an organization can track how employees are spending their time, specifically for that salaries line item, the better understanding you're going to have in what it takes in costs to run a program. All right, so estimates could be fine, but your delta, your margin of error might be a little larger, and then we might not have as the most accurate information on how best to understand how much it costs to run this program. And so it's really up to you all to find, that fine balance of a cost benefit analysis. And like I said, it's not always a requirement to use timesheets. There can be other methodologies, periodic reporting, estimates, things like that. And really, again, other basis, timesheets and salaries, while they are the most popular, don't need to be the only way to allocate costs. One of the things that we see a lot, especially for organizations that might have a little bit more complexity, have multiple locations, have multiple field offices or departments, and this department is 100% dedicated to programmatic activity on this grant. Allocating, let's say, office space could be based on square footage or number of people in that department. And so, that that can certainly be the case for larger organizations, even smaller ones, that can get a good understanding of cost rent being allocated based on those square footage of where employees are working or how departments are structured. We also see oftentimes where it's an organization's activity to serve participants. And so maybe the number of participants served in program A versus number of participants served in program B might be a better basis for allocation than how employees are working. And so, that's another option. And really, there are lots of options on how you do these things. But ultimately, it comes back to documenting your specific policies, approach, procedures, being consistent against those procedures and policies that you have documented, and communicating that internally to all the departments in your organization so that the programmatic people who don't live and breathe in the finance world really know the importance of capturing costs or understanding where they're spending their time, which then rolls up into the functional, which then rolls up into a statement that our donors see and flows down to the watchdog organizations that all our funders see. So connecting those dots and giving that internal education throughout your firm also becomes pretty critical. So hopefully many of you are already aware that there have been several new accounting standards released and will be required to be implemented over the next several years. And so we're just on the cusp of the very first one, which is ASU 2016-14, which is the change for nonprofit financial statement presentation. So December 31st, 2018, year ends will have to implement this this year. So those of you that are about to close out your calendar year end, your fiscal year end, this will be a requirement. And while there are a number of requirements that go into this standard, I'm actually only going to focus on one piece of that today as it relates to the functional expense statement. And we've already said in the beginning that this used to be a best practice. It will now be a requirement to include a statement of functional expenses in your financials. And so there are three presentation options that they have given us. First, on the face of the statement of activities. It could be presented in a separate statement, but as a basic part of the financials, or it can be disclosed in the footnotes. But I know we do have some clients, organizations that have been including it as a supplemental schedule to the financials, and that is no longer acceptable. So that would have to be moved up into the basic part of the financial statements. One of the other things that they have expanded on as now a requirement is to not only include this statement, but also to include a footnote on how the organization has allocated its costs. And so that is different for everyone because typically organizations aren't expanding in a discussion format on their approach, their allocation methodology. And so all the things that we kind of very high level just walk through will now be required to be disclosed in a discussion in the footnotes. And so we have included a couple of examples of what that discussion might look like. And so, in the first one, they have consolidated statements. They have specified that expenses supporting more than one function are allocated based on function benefits, whereas the other one are being allocated based on an informal time study of time spent on each program. And so here they've each specified how they've approached that allocation methodology within those statements. And so now I'm going to turn it over to our first polling question.
Okay, thanks. We have our first polling question here. Have your functional allocation methodologies been reviewed for reasonableness in the last 1 to 3 years? Please select your answer, either yes, no, but they have been reviewed before, or no, and they haven't been reviewed before. Please take a moment to answer right now, and while everyone's recording their answers, I'm going to provide the first CPE word. The first CPE word is trend. So if you want to receive CPE credit, please jot these words down. You're going to need them at the end of the webinar for the survey. Again, the first CPE word is trend, T-R-E-N-D.
Great. So most of you have responded that you have taken a look at your functional allocation methodologies within the past 1 to 3 years, which is perfect, which is what we would expect. So kudos to you. And those that haven't reviewed before, obviously, we're trying to give you some guidance to be able to take this back and do so within your organization. And so with that, I'm going to go ahead and hand it off to Andreas.
Thanks, Jen. Thanks, Lindsay. And thank you all for joining today. In this section, we're going to address indirect rates, including basic concepts and definitions and the impact of ASU 2016-14 on indirect cost reporting. We'll also review a sample indirect cost rate calculation in order to review how it's connected to the organization's functional expense statement. An important question to ask is whether the new ASU will affect indirect cost rate reporting. Well, now that organizations are required to report functionally and naturally, which previously was not a requirement for all organizations, and also required to disclose its functional expense statement, preparation policies, and procedures in the notes of the financial statements. And that exercise may result in presentation changes possibly. Readers will take a closer look at the organization's numbers and assumptions in drawing their conclusions. Therefore, it's important that organizations who report to donors, whether they're federal or non-federal or other, that the data related to efficiency and performance, including disclosures on indirect rates, is defined throughout as many external and internal financial reporting documents. There are several differences between reporting under GAAP, generally accepted accounting principles, in an organization's financial statements, specifically the functional expense statement, and reporting direct and indirect expenses to donors for indirect cost rate purposes. And following are some examples. Certain classic G&A, general and administrative salaries for financial statement purposes may actually be considered direct costs to a particular donor or program. The cost of supplies could be a direct cost to a grant, but an administrative cost for financial statement for GAAP purposes. And the allocation of certain benefits to employees charged to grants may be presented differently for GAAP or financial statement purposes. And we'll cover some of these details in some of the future slides. But first and foremost, as a matter of background, it's important to identify costs and the relation to the indirect cost model. And assessing the indirect cost rate structure of an organization is important because it provides management with a roadmap for identifying its program and non-program or supporting services costs. The indirect rate calculation allows management and others to see all the costs required to run the organization as a part of carrying out its program activities. Management can make more informed decisions such as where they can strengthen infrastructure or where cost can be cut. And as a part of that process, management can periodically review definitions of cost classification to see how they're defined in policy manuals and to go over and evaluate changes to those definitions if necessary, which of course is an exercise that a lot of organizations are going through as we speak in connection with the updates included in the new accounting standard update. Presentation and communication of important ratios. Organizations should help donors and others understand the indirect rates and how to translate them into a conclusion that allows them to make good educated decisions. Administrative cost recovery. These are the costs that represent a fair share of what is due for allowable non-program, non-direct project costs that, of course, are necessary to carry out the project or the program. And ratable allocation to programs can be accomplished easily if the cost assumptions are clear and reasonable, and the organization has a reliable accounting system that properly tracks and reports all types of costs. When a good cost allocation policy is in place, these assumptions can be very easily communicated if they're ever requested to donors and others. Let's first start out with some basic definitions. What is an indirect cost? And Jen covered a little bit of this in the previous section, but an indirect cost is a cost that is not directly accountable to a specific cost objective or a particular project or activity. An indirect cost has multiple cost objectives. This type of cost benefits a multitude of activities. As an example, rent, utilities, insurance, supplies, and others are examples of indirect costs. They cannot be attributed to a project, but indirectly add value to all the programs of the organization. Most organizations classify indirect costs as general and administrative expenses. We'll also discuss how these indirect costs can be presented in the functional expense statement as program expenses. A direct cost is an element of an expense that can be completely attributed to the delivery of a specific good or service. Typically, a direct cost is presented in the functional expense statement as a program service cost. This has a singular cost objective. This type of cost benefits a single individual program activity or function. The indirect rate allows the organization to allocate costs across programs using assumptions consistently applied from one period or year to the next, and the assumptions are clear and properly documented. Donors are certainly very interested in understanding the total cost of the organization, not just the direct cost to run their specific program or project. It's important for organizations to communicate to donors that they are responsible for paying a fair share of indirect costs to run that program. And if that fair share reimbursement of such costs is not provided, then the costs ultimately have to be funded by the entity itself as a loss, as a subsidy. Organizations that run many projects generally cannot specifically identify all indirect costs specific to that project, and so it's certainly better and more efficient to allocate using an indirect rate approach. By spreading the costs on a pro rata basis according to the size of program activities, by taking a simple ratio of allowable indirect costs over direct costs, is typically the most common and appropriate rate model, although there are some other ones as well. So what is a reasonable indirect rate? The short answer is there isn't a specific figure that makes sense for every organization. Comparing one company to another is an important part of the reader's education, the readers of the financial statements and tax returns, and understanding performance and efficiency. However, the cost assumptions and definitions between organizations may be different. There are basic concepts that should be considered, such as understanding and identifying what is an indirect cost, what is a direct cost. But in the end, actual definitions may be different between those organizations, and the administrative structures and cost assumptions may not be designed exactly the same for one entity to another. ASU 2016-14 has created a better roadmap for readers of financial statements and understanding numbers in a more transparent and articulate manner, and therefore the consistent communication of ratios and other administrative percentages to readers through the indirect rate calculation is a critical part of the external financial statement reporting process. There are certain organizations that claim they operate at 5, 6, 7%. A quick review of those financial statements may lead the reader to conclude a different percentage. Additionally, a very similarly sized and structured organization may claim 18%, but the financial statements speak to that rate through a quick review of those numbers. So why are there differences in the industry? Why do so many people think that 15 to 20 or any other percent is a better, more reasonable range to fall into? Well, the important question is what type of rate is being used? What are the assumptions? If the entity is receiving funds from the US government, are they using a modified total direct cost methodology, which at a high level includes taking the ratio of indirects over directs? Is the rate based on salaries and wages? Is it something different? There are recovery rates that report on administrative costs related to just the administration of subawards, which may be a much lower rate, and those costs are then not included in the overall basic indirect cost rate calculation for the organization, which is that rate that the public is very interested in evaluating. So the entity's methodology and how it presents to the public is critical in mitigating negative public perception, and that the organization's rate, or if the organization's rate is not reasonable or within acceptable ranges. So there's a lot of perception that goes into this. Readers of the financial data gain information from a variety of means, the 990, the audited financial statements, and other tools, but these are the most commonly used by donors and prospective donors to draw conclusions. So it's important that the methodologies on cost allocation are clearly identified in the footnotes of the audited financial statements, as now required by the ASU, on the entity's website, verbal communications, et cetera, as to how the rate was established, how it was calculated, and how the organization supports it. And policies and procedures, will always suggest that policies and procedures be documented. Certainly, it's important that when it comes to anything accounting related, that indirect cost rate policy and procedure should be established. Organizations receive a variety of funds from a variety of donors, including foundations, foreign governments, the US government, and cost recovery may be different based on different assumptions, which could yield an optically different percentage or a lower or higher percentage, but with different reimbursement assumptions. The source of the financial data used to justify indirect rates typically is the organization's accounting system, and ultimately that functional expense statement that we've been talking about this morning. So varying rate assumptions or reimbursement opportunities from one donor to the next should not be influenced by that functional expense statement. The importance of that statement is that it's a basic source of data that's available to the reader or the donor as a baseline for justifying that indirect cost reimbursement. Indirect cost recovery rates in a non-federal setting are generally lower, optically lower, than those provided under federal assistance programs. The actual reimbursement of costs may be similar. Why is that? Through careful and thoughtful planned budgeting and negotiations with the donor, this can be accomplished. Depending on the entity's ability to understand budgeting for full cost recovery, classic indirect costs, administrative expenses may be billed as direct expenses, as direct costs, so that a lower rate and a lower overall rate will not impact the organization's overall reimbursement opportunity. What happens in this case is the entity is recovering a smaller percentage on a larger pool of costs. That pool could include, again, these classic indirect or administrative expenses that donors are willing to consider as directly chargeable costs. And then the combined pool of costs is the basis for the indirect rate application and recovery. So in the end, a fair share of reimbursement may be provided to the entity. Most organizations believe they're not recovering full administrative costs, as the percentage does in fact appear lower. So the assumptions that go into developing the budgets are critical, as the actual recovery may be in line with its classic indirect cost rate model. Ultimately, the government provides the most clear and transparent reimbursement structure, as they typically pay the organization's full indirect costs. But then again, the non-federal and foreign government recovery rates and rate structures may provide similar reimbursement opportunities. And so really understanding how those budgets are developed is critical. If an entity is unable to model out a fair cost recovery from a non-US government source, they should be prepared to decline those funds or accept a lower overall recovery, understanding the gap is funded by reserves or unrestricted gifts, which means that there needs to be some fundraising involved in covering those shortfalls in the current or in future years. In the end, the organization should be accepting grants that allows it to recover 100% of the administrative burden that's associated with running that particular program, however that budget is structured. The current climate in the not-for-profit world is to lower indirect rates as much as possible. This is the unfortunate reality of the world we live in today. There are certain entities that promise to deliver programs at 100% while subsidizing its administrative costs through alternative fundraising methods. And certainly this model can work well and be very successful, but for organizations that are funded in a classic restricted donor or a US government or other government funded climate, they have to find ways to reasonably and fairly maximize the reimbursement opportunities. Competition for awards has really forced organizations to be more strategic, which is important, as they must make sure that indirect cost recovery shortfalls aren't straining reserves or other unrestricted resources.
Okay, we've come to our second polling question, and this is a follow-up on the previous polling question. Does your organization communicate its indirect rate externally in the annual report, on the website, or in the financial statements? Please respond yes, no, or what is an indirect rate? While you're taking a moment to answer, and providing your responses, I'm going to provide the second CPE word. The second CPE word is nonprofit. Again, if you want to receive CPE credit, please jot down the words because you will need them for the survey following the webinar. The second CPE word is nonprofit. NONPROFIT.
Okay, so it appears that most organizations are not communicating indirect rates externally. Certainly there isn't a requirement here, but it's important that an organization, when it does report to its major donors and presents financial statements with, and we'll talk about some of the misconceptions of indirect rates at the end of the presentation. But it's important to be able to say, okay, well, these numbers are representative of our overall administrative burden or our indirect rate calculation. But in any event, we'll go through some of the examples as we get towards the end. We think it's important that that as much transparent communication to the public as possible, the better the organization will publicly report. As a matter of background, and in setting the tone for the basic indirect cost rate options in the U.S. government in a federal setting, I'll review some of the guidelines and definitions related to basic indirect cost rate assumptions. It should be noted that these concepts have not been amended in connection with the implementation of ASU 2016-14, but the concepts, they set the framework for understanding how the financial statements, specifically, again, that functional expense statement, is the basis for indirect cost rate statement preparation and reconciliation, ultimately through the uniform guidance report that's filed at the end of the organization's financial year. CFR 200, specifically Appendix 4, sets the standards for which organizations must follow in determining the classification of costs in relation to the preparation of the rate. It's important to understand the basic concepts to ensure the preparation of the rate is reasonable and consistent from one period to the next. So what is an indirect rate? How does it work? It's simply a mechanism of determining fairly, within the boundaries of sound administrative cost principles, what proportion of indirect cost each program should bear. Indirect costs are incurred for common or joint objectives and cannot be readily identified with a particular grant, contract, or other activity of the organization. The concepts are similar to what we've discussed in prior sections, but spelled out specifically in uniform guidance. And the indirect cost rate is a ratio between indirect expenses and defined cost base. The methodology used by the organization will depend on the structure, its functions, its accounting system. But again, in the end, policies and procedures are certainly critical and imperative. So who's covered and what awards are covered? Organizations that draw funds directly as a prime recipient from the U.S. government should apply for a NICRA, a negotiated indirect cost rate agreement, and affirm that on an annual basis. The organization that has not previously established one with the federal agency submits an initial indirect cost rate proposal right after the organization is advised that an award will be made to them directly. The proposal is prepared by the entity in accordance with cost principles and to substantiate its claim for the reimbursement of indirect costs. The rate in the supporting schedule is used to arrive at the indirect cost pool, include the amounts in the base calculations. And the proposals are based on the most current financial data supported by the organization's audited financial statements. Again, the basis here being the entity's functional expense statement and related assumptions for the preparation of that functional expense statement. The federal agency with the largest dollar volume of awards to an organization will be designated typically as the cognizant agency for the negotiation and approval of the rates. And assuming a simplified NICRA method, negotiated indirect cost rate agreement method, entities are required to submit a new proposal to the agency at the end of each fiscal year. The rates for that fiscal year are typically certified by the external auditor in the body of the uniform guidance report and are based on the final audited expense figures. The agency that's responsible for approving the NICRA at the government level reviews the rates and subsequently provides a final rate for that year and then a provisional rate for the subsequent year, assuming that they're using that final and provisional rate methodologies. And we'll talk about methodologies in a couple of minutes, but there are alternative methodologies there. There are four basic concepts related to the identification and assignment of costs for the purpose of rate determination: allowability, reasonableness, consistency, and allocability. Allowability refers to the total cost of administering a federal award, and that has to do with the sum of the allowable direct and indirect costs. And to be allowable, it should be necessary and reasonable for the proper and efficient operation of the program, consistent with policies and procedures that apply uniformly to federal and non-federal activities of the organization, provided with consistent treatment from all the activities of that organization, and adequately documented. A reasonable cost is one where the nature of the goods and services received and the amount reflect an action a prudent person would have taken in the circumstances at the time the decision was made to incur that cost. The cost should be recognized as ordinary and necessary for the operation of the organization, the performance of the award, and it should be incurred in an arm's length transaction. A cost is consistent if it's treated and applied in a similar manner from one period to the next. Consistency is important, especially preparing the indirect rate to ensure there aren't deviations and assumptions from one year to the next. And an allocable cost to a particular cost objective if the goods and services acquired to meet the cost objectives, considering the relative benefits received. Considerations related to allocability include evaluating the objective as to whether or not it was necessary to the overall operation of the organization. The U.S. government typically issues provisional and final indirect cost rates. However, there are other rate structures that are not as commonly used by many organizations. Under CFR 200, there are the negotiated provisional and final rates, predetermined rates, fixed rates with carry forward, and then the fallback de minimis 10% flat rate. Under a negotiated indirect cost rate, a NICRA agreement, organizations must apply for the NICRA and every year reattest to that rate. And all agencies of the U.S. government must honor that negotiated rate. So if you're receiving funds from a variety of sources, all federal agencies, they should be ultimately honoring that NICRA. Absent a rate, the 10% de minimis is automatically assumed. But in this particular case, with the NICRA, the provisional rate is the temporary indirect cost rate applicable to the period in which you are applying for funding and reimbursement. And the reporting on indirect costs award happens after the establishment of the final rate for the previous period. So the provisional rate comes at the beginning of the year, and it's based on the final rate typically from the previous year. And then the final rate is established. It's applicable to the year that closed, and it's based on the actual known costs of that period. So the final rate is not subject to adjustment. Once it's established, the rate is used to adjust the indirect cost claim during that and any perhaps subsequent periods. Predetermined rates are permanent rates established for a specific current or future period, not subject to adjustment. This could be used on awards where there's assurance that the rate is not likely to exceed a rate based on the organization's actual cost. So it's enforced usually for a longer period of time. A fixed rate is a permanent rate for a future prospective period of time, and the actual costs are determined by the organization, and the difference between the fixed and actual rate is carried to a future period in order to adjust for the fixed rate for any over or under recovery. Generally speaking, the NICRA provisional and final rates are the ones that are most commonly used because they're tied to the costs are tied to the year that you're incurring those expenses. There aren't prior year indirect costs carried into a future year. There's no profit or loss opportunity. And then the final one here, the de minimis rate, this one is simply for organizations that do not have a NICRA. They have less than 35 million in federal funds. And it's also commonly used in the case where there are subgrantees where a rate has not been decided, and at a minimum, they are afforded a 10% reimbursement rate. As discussed earlier, the entity's financials are the basis for calculating the rate. The preparation of the functional expense statement is the starting point, and the calculation may reflect a reconciliation between the categories, between indirect, indirects, or vice versa, to properly categorize costs which have been presented differently in the financial statements. There's a variety of reasons to support this reconciliation. Following some examples. The first could be the classification of classic administrative costs that were presented as program services expenses in the functional expense statement. So they were allocated to programs based on the entity's documented cost allocation methodology, but they need to be placed back into the indirect cost pool. So there'd be a reclassification from the direct pool to the indirect pool, thus creating a larger indirect percentage. Another example would be the classification of indirect costs to the direct cost pool for those that have been classified as indirects, but they've been reimbursed 100% by certain donors under non-standard reimbursement arrangements. And so the movement of the cost from the numerator, the indirects, to the denominator, the directs, results in a mathematically lower rate. But again, this should be acceptable, as it should be, because that cost, or the group of costs, has been already reimbursed dollar for dollar by that particular donor and should not be included in the indirect cost pool for ultimate reimbursement, again, by other donors.
Okay, we've come to our final polling question. Has your organization updated its expense policies and procedures to address indirect cost rate assumptions? Please select yes, no, not yet, or I do not know. While you're taking a moment to answer, I'll provide the third and final CPE word, which is policy. Again, the final CPE word is policy, P-O-L-I-C-Y.
All right, so a variety of responses here. Ultimately, expense policies and procedures, how functional expenses and indirect cost rates work together, certainly an important part of an organization's documentation process with respect to how it justifies its cost reporting, and certainly there should be more yeses in there, but perhaps something for each and every organization to think about. And of course, we are available to anyone who's interested in having a discussion about how that could be accomplished. In the final couple of slides here, we have a sample indirect cost rate calculation. And what I'm going to do is just jump right to the exhibit, just being mindful of time here. We have a sample statement indirect rate calculation, your basic indirects over directs. The starting point here is that functional expense statement again. So very important that that functional expense statement be prepared based on the organization's policy and procedures and analysis of what's a program cost and administrative costs, what's fundraising, what's development, what's the differences there, and then how do we present it in this statement. And so that to ASU 2016-14 and the definitions associated with the statement are important, because it's possible that organizations could report differently. But again, ultimately, we have to report back on actual indirect costs in this statement. Some of the reconciling items between the functional categories and the direct and indirect categories. We talked about how we could be moving from indirects to directs or vice versa based on perhaps costs already being reimbursed and it should not be included again in the indirect pool. There could be some other costs here, such as in-kind or donated services, that need to be removed because they're not actual cash expenses. There could also be an opportunity for organizations that receive or that actually have outgoing grants to other organizations, assistance awards in excess of certain amounts. In this illustration, we have $25,000 as the threshold, but there are organizations that have negotiated different thresholds with the U.S. government. And so what this does ultimately is it comes down to a percentage of 18.98%. And what does that mean? Well, that means that for every direct dollar reported, that's that 18.98% reimbursement of administrative expenses should be attached to that cost. But you take a look at this rate, and this is in accordance with U.S. government standards. We're looking at the federal rate here, 18.98, but then you can take a look at how other people may translate this into a different percentage. You could look at this and say, well, the total administrative costs over program and fundraising could be 16.06%. If you don't take out those reconciling items. You could take total administration over total expenses without the reconciling items and get to 13.84. You could also get to 16.86 if you put the administrative costs over total program costs. And there's a variety of different ways to look at this, but in the end, how we communicate this rate to the public through our financial statements, through other means, is important, because donors and others, they want to know what our administrative burden is. They want to know, are we efficient? Are we not efficient? And if we're not efficient, why is that? Well, there are specific reasons for that. But ultimately, being transparent about how this works is important, and ultimately understanding how the functional expense reporting works together with indirect rates is an important part of external financial and donor reporting. So thank you very much for your attention. Do not hesitate to ever reach out to us to discuss these concepts in greater detail. And moving on to the final slide here, if there are any questions, please don't ever hesitate to come back to us, and thank you for your attention today.
Okay, thank you, everyone. Unfortunately, we don't have time to go into detail on the questions, but as Andreas said, please reach out with any to the presenters. Their contact information is presented, and we will, help you with those questions. Please remember also to complete the emailed survey that will be following the survey if you would like to earn your CPE credit for attending today's webinar. Thank you all and have a great day.